Hello, welcome back. This is Kevin the Trader, and I want to start from scratch. But I want to teach you price action from A to Z. Now, if you're new to the Forex trading market, then you should know that it's kind of hard and it's kind of tough. But if you follow this video step by step from A to Z, then you'll understand what price action is, and after you finish this video, you'll be able to trade Forex without any problems. So this is the introduction to price action Forex trading. So this strategy is best for all the market pairs, right? So you can trade all the market pairs. That includes crypto, you can include commodities and all that stuff, right? So it's not only applied to Forex trading, but it's also applies to other instruments. So this strategy is highly versatile and can be effectively applied to all the Forex market and across all the Forex currency pairs. So its adaptability makes it suitable for a wide range of trading conditions, whether you're dealing with the major pairs like Euro USD, GBP USD, or other minor pairs like AUD CAD, or even exotic pairs. By focusing on the key principles such as the trends analysis, support and resistance levels, and proper risk management, this approach can yield consistent results regarding the specific currency pair being traded. So additionally, its broad application allows traders to diversify their portfolio and take advantage of opportunities in various market environments. You may be once taught that you can only trade one pair or two pairs of Forex. With this principle or with this price action method, you can trade any Forex pair, from major, from minor, even exotic pairs. You can just put them on your, so if it's in line with what you're going to discuss in this video, then you can definitely trade it. We are going to understand the market and identify the zones. The price action refers to the movement of a security price over time. So when the price of a pair or price of a commodity or price of a crypto is moving over time, then in the charts we term that as price action, right? And it's often analyzed using historical prices to make trading decisions. So you analyze the data that is not the pair, or the charts, then you can use that historical to make your trading decisions. So traders who use price action typically focus on the following aspects. So the candlestick patterns. So if trading price action, then you have to know the candle patterns. Okay, and these formations on the price charts that represent the price movement over a specific period of time. And common patterns include the pin bars, the engulfing patterns, and the dodges. We'll come to understand what these are, but if you can go ahead and you can also read them. The support and resistance level. The price action also identify the key levels where the price tends to reverse or stall, providing insights into potential entry or exit. So we are going also to identify these key levels, right? So maybe you watch one or two videos here and there, but you didn't understand what support and resistance levels are. Then in this video, I'm going to show you step by step on what they are and how you can use them. Another thing is the trends. Understanding whether the price is in uptrend or downtrend or sideways movement helps the traders to make decision about buying and selling. So you can, if the price is going up, then you don't sell. If the price is going down, then you don't buy. So if the price is going up, you buy, and if the price is going down, you sell. And another aspect is the volume. Analyzing trading volume alongside the price movement can help you confirm the trends or the reversals. And the last, the chart patterns, which the patterns are triangles, heads, shoulders, flags, indicate full price movement based on historical behavior, right? So overall price action is trading emphasizes of using raw price data without relying heavily on technical indicators, allowing traders to make decisions based on the market behavior. When we are using the price action, we are not going to use any other technical indicators that you see around that makes the chart dirty. So we are going to use just simple methods, okay? And forex trading is simple. Forex trading is simple, and use the simplest method as possible for you to understand the market. So in this video, I'm going to show you what those are and how you can use the minimal patterns without technical indicators make your trading decisions. As a price action trader, you're required to trade without indicators whatsoever. Only use candle formation in our trade. I've taken this image from, have a FX replay here. This is a replay software, and if you want to replay all your trades, then you can go to this replay software. I'll also in the near future show you how this works. We only have like the price is going up, the price is going down, and the price is going sideways. For any chart or for any price action chart, you'll only get three things. First is the price is going up, like the price was going up here, then it went down, then it went sideways, and then it went up. So when it goes up, we are only looking for the buy opportunities, right? So if the price is going up, don't look for sales here, because you'll actually be taken out, because the dominant trend is an uptrend. If the price is going down like this, then we don't look for buys. We don't look for buys like in a certain points like here. We are looking for buys here because the dominant trend is a downtrend. So you'll be taken out. So if you understand these rules that I'm going to mention here, then most of the time you'll get correct on your trades. So if the price is going up, then only look for buys. If the price is going down, only look for sales. So when the price is going down, we are looking for sell opportunities. We don't look for buy opportunities, because the dominant trend is sell. And if the price goes sideways, then we don't do anything. Okay, we don't do anything here. So like here, the price was going sideways like this, we were not doing anything, then we are waiting for a breakout. And this brings me to the third point here, that when the price is going sideways, we are looking for breakout. Up to buy, because it has broken up, then we are looking for buy opportunities. And if it breaks downwards, then we're looking for sell opportunities. But here you can't buy or sell. Like for example, the price was going down and I look for sell opportunity, then when it reaches here, it reverses. So it is kind of messed up in this situation. So we're looking for some breakouts from here, and then we can look for buys or we can look for sells. Like in this place, let me just replay into this FX replay and you see what is happening. So we see the price was going sideways, then there was a breakout of that sideways, and then now we're looking for buy opportunities. You see? You see? The price broke this sideways, and then we are now looking for buy opportunities. We are not looking for sell opportunities. That's why you see that there is a kind of a retest from this structure, and then the price is still moving up. Look, for example, the price broke up this structure, this sideways structure, and then came back to retest support level, and then it went up. So we're looking for buys opportunities after it retests this line here. So make sure you understand that we only look for buy opportunities when the price is going up, and we only look for sell opportunities when the price is going down. We are looking for a breakout when the price is going sideways. If it breaks up this level to up, then we're looking for sell opportunities. But if this could break up to this point here, if it could break up this point here, then we'll only look for sell opportunities. For example, here we can see clearly this was our swing point, and you see this was our swing point, and the price broke up. Okay, So the price was just dangling in between the up version. Okay, let me just label that. So I'm on a 5 minutes time frame, and this is now our 5 minutes high. And this is our 5 minutes low. Okay, so we are on a 5 minutes time frame, right? So we have a high here and a low here. If the price was dangling in between the high and low, so that means the price was in a state that is not going up or is not going down. So when it broke up this point, it first broke up this point here and then went up. Then we see the price now is now breaking now the high. So we know that this is now a buy opportunity. We're not looking for sales over here. So always work with the current price action. You see, as we can see, I'm not working on any price action that was passed right here. This is the past price action. I was just doing some replay here. You see, I was just doing some replay here. So we are not using the past price action. We are actually using the current price action. In the price action, we are not always looking for the past price action. We are working currently with the current price action. So if you're looking at the past price action, then that is the past, okay? And we should only act with something that we have at present, because we don't know what happens in the past. We only know what is going to happen in the future. So that's why we're looking at the current price action. That brings me to this point here. Always work with the current price action. When you click your MT4 or MT5 or trade view, like this is now our replay and it's working on a trading view, then we are only working with what we see in the charts, okay, or the charts, right? And at that current time, working from right to left. So we are working from right to left. So we are only dealing with something that is on our is current, and then working from right to left. It's simple. Okay, the price action will tell you everything about the market. Okay, and the example is as below. Let's go step by step. Now, since we are looking at the top-down analysis, then we should start with the 4-hour time frame as we go down. Now, this depends with the kind of trader you are. If you are a swing trader, then you will start with the weekly, then you go down to daily, and then you go down to 4-hour time frame where you'll enter the market. But because I am doing this as a day trader, then I'm going to start with 4 hours, then I go to 15 minutes, and then so this is where I look at the direction of the market, and in 15 minutes I'm going to look at the entry point and the best points to enter, and then I will narrow down it to 5 minutes time frame or 1 minute time frame to get the exact precise entry points for my trade for the day. So in this one, then I'm going to start with the top-down analysis, then the market formation. Okay, so the market is going up as per now, and if we look at the past, because we say that we're not looking at the past price action, we are dealing with the current price action. So we're looking at this kind of a price action here, and then we'll narrow down. Then we'll narrow down to a lower time frame. So the current price action, this is the current price action, how we say it. And if you look at it, we see that there is a lower low here and the lower high. I mean lower high, higher high, and then this low. Okay, let me just mark it. This low is responsible to make this high. and then this high is responsible for this low. Then this low is responsible for this high is responsible for this low is responsible for this, and so on and so forth. Okay, so as you can see, now we had a trending line here. Over here this was a trending line, and then it went down and up and down. So this was a trending market. So let me just mark that one. Let me just mark that one. It's a path. So this one was like, this was a trending market. It went up, it went down, it went up. This was a trending market because we see that the high does not take up this low. Okay, so this was a trending up market, and the low, and we see this low fails to take up this high. So that means there is a possible reversal, right? Because this low took up this high, this low took up the previous high, then this low took up the previous high, but this low did not take up the previous high. So that means there is a potential of a reversal. We say potential because we still don't know if it's a reversal or not. So it is a potential of reversal, but now we see that it is not a potential anymore, but it's now a reversal. So we see that for a high trend, okay, for an uptrend, then we see we have strong lows, because the strong lows take up the small, the weak high. So if a low takes up a high, then this one becomes a strong low. If this low takes up this high, then it becomes a strong low. But if this low fails to take up this high, then it is not a strong low, it becomes weak. Then if this high takes out this low, if this high takes out this low, then that means this one becomes a strong high. This is a weak low. This was a strong low. This was a weak high because it did not take up this low. But this high took up this low, then that means we have now a change of character over here, right? So the market sentiment will now be going down instead of up. So if I can replay this, you can see what is happening. I'm on a FX replay, and on a 4-hour time frame, then this is, you see, the high, you see the high, the low does not take up this high, right? So this high, then we'll see that this high will end up taking up this low if we continue with it. So but my point was, if the low takes up the high, then it becomes a strong low. If the high takes up the low, then it becomes a strong high. So this one will become a weak high. So unless we continue with this, but if it takes up this high, so let me just do it and we see what was happening. So this low has now taken up this high. So that means, so you see, the low has now taken up this high. So that means it went up this high. So it didn't attack this high. So this one still remains our strong low, because our weak low, because it did not take up this high. Then we have another low, and then we have another high. Okay, so this high now takes up this low. Okay, so this low takes up this high. So that means this one is now a strong low, and this one is our weakest high as per now. So you see, we have to go to a top-down analysis before we start trading. Okay, we don't rush into our trades because we actually don't know the movement of the market to span up. We're still figuring out where the market is going up, right? And we have to figure out that, because if we don't, then we'll be losing some money. We will be losing our accounts each and every single day. So we have to know exact trend of the market before we decide to trade. So for you to decide to trade, you should actually know that when we are on a 4-hour time frame, like we are now, that means each and every candlestick represents 4 hours, right? Each and every candlestick represents 4 hours. So we're trading, we start our analysis from the 4-hour time frame because each and every candlestick represents 4 hours. Okay, so that means if the market is going up, so that means there is a very, very big likelihood that the market is going up, because this 4-hour candle, this candle represents 4 hours. So that means if we go to a 15 minutes time frame, we'll see the same exact thing. You see the points that we marked, right? But each now candle represents 15 minutes time frame. And because the market has, the sentiment of the market is now decided to go up, then we only look for buys over here. We don't look for sells. So let's just play it out and you see. So if something's like this happening, then we should not look for sells, right? We should only look for buys in this, because our market trend is up. Why should we look for buys and our market trend is going up, right? So we should only look for buy opportunities, not a sell opportunities, as we said earlier. So if we just replay this, we see that there is kind of a pullback. Okay, you see there is kind of a pullback, and then something goes up. So you can't just take your sells from here. You just don't know how long this pullback will last. That's why after reaching this point, then it's still going up. Okay, after a break of this structure, you see there was another break of structure here. Okay, so it went up, it failed, it will break up this structure, to break up this key level, and then there was some fake outs, okay, which are called liquidity pools, and then the price is going up. So we can't just take sales from here because we don't know how long that pullback will last. And another thing, if you don't really understand how these charts, okay, if you don't really understand these bars over here, you don't know actually the direction of the market, you can convert. This one is available in MT4, MT5. It's also available in TradingView. It's now also available in FX Replay, because FX Replay works with TradingView. So we go to this and we convert this to line graphs. Okay, so you can see everything. You can look at the charts microscopically, because if you don't understand, was this up or down, right? You can just look at this using these line graphs to show you everything that you want to know before you just convert it back to your bar chart. The main reason of converting your chart to a line graph is from bar chart to line. That means we are now leaving out the wicks. If we convert it back to candles, you see that there are wicks. Okay, there are wicks here. So we are leaving out the wicks so that we can identify the spheres. So when you go back to line graph, if I go back to graphs, the graph will not now show us the wicks. So that is what we call spheres, and they are very protected points, and they are also reversal points. So let me just show you the spheres look like. If we convert here, let me just mark up this out. Let me just mark this one. Let me just remove this line, and we see, let me just use this to mark up. Now this is now the end of the week, this is now the low of the week, this is now the low of the week, this is now the end of the week, right? So we want to convert this into a line graph. Let me just convert this to a line graph and you see what I mean. So you see all the marked point was the end point of a week, but now we don't see a wick in the line graph, right? We don't see the wicks. So that's why in doing that, in converting your chart to line graph, there are these particular points which are called the spheres. And you see, these are the points for reversals. And you can see any place where you see some wicks, you see a potential reversal. So this one, the wick was here. So this was a downtrend, and there was a reversal after this wick to uptrend, and after this wick to a downtrend. And you see, after every week we see an uptrend. So with the line graph, you can't see these things clearly, but with this particular line graphs, you can identify them each and every single time. So whenever you see a sphere like this, you see that there is a potential reversal. So when you want to take a trade, right, and you identify a sphere, you should know exactly that there is a potential reversal, and you can take your trades accordingly, knowing that these are reversal points. The spheres are protected areas, and there is always a reversal when the price reaches up these points. So as you can see, this is a sphere. The price went up, and reaches this point and reverses. The price from this sphere reversed up, okay, and here and any other place. So these spheres are the protected places and act as a reversal. And as you can see, the price took a lot of time to pass through this point, and also the price took a lot of time to pass through this point. So these are protected areas, and they are the support and resistance levels. And if we go to other areas like these areas, you can see this is a protected area. Let's just look. Let's just find where it was starting from. Let's take, for example, this point here. So you start up this point to that point. You see this is a support zone, right? And we see the price, when the price comes up to this point through these spheres, we see a reversal, and then other spheres here. Okay, so there is another sphere here. Sorry, this one here. When the price reaches up this point, it reverses. So the price came up when it reaches this point for this sphere, and then it reversed to create this now support level. And also the price is having a hardship to pass through this point here, and then we have some spheres up here, and we see kind of like a double top, and then the price reverses to this point, and then another sphere, the price reverses, then another sphere, the price reverses. Okay, so we get some liquidity grabs, and then the price goes up. So, and when we look at this point in this 15 minutes time frame for gold, then we see that when the price broke up this support level, then we see a retest, and then it goes down for a little bit, and then it goes up. So our points over here is that the spheres are much protected areas. So for you to identify them, then you have to convert your chart to line graph instead of the bar graph. When drawing a support level, as we have drawn here, the support or resistance level is a point that has many touches, like here. Okay, so this one of the first one, the second one, the third one, the fourth one, the fifth one, and the sixth one. So this is a support level. So if you want to draw any support level, then you should know, or you should find the point that touches the line for several times. Then that line will be now a support level. Same as resistance level. So this, we see that this is first, this is a second touch, or nearly a second touch, then the third one, If we have two or more, then that becomes a support or resistance level. So in this case, this one is a support and this one is a resistance. So for you to identify the support and resistance levels, you should take analogy of a bouncing a ball. So when the ball comes up to the floor, then the floor acts as a resistant, okay? I mean the support. And then when it goes up, this one becomes a resistance because it does not allow the ball to go up, right? So this is a support, this is a resistance, and this is a support. I mean support, resistance, then came here to support, then a resistance, then support, then it didn't go up, support, and finally the support was now disrespected over here. So for you to identify the support of resistance level, then first of all, we should have these points here. So if it touches 1 or 2 points, then that becomes a resistance level, and down here it now becomes a support level. At this point, when the price comes out to our levels, key levels, which is the support and resistance, we see that there is a kind of rejection from that point. So we see a rejection from this point. That means the price does not go up to the upward direction. So we see a resistance from this point, and then we see the price was coming down. Then we see a support here, but it's not violating this point. It doesn't go down. It's just some liquidity grabs, and then the price goes up. So we find that if you mark your charts very well for support and resistance, then you'll find that those would become your reversal point. So when you're placing a trade and the price reaches that point, then you'll definitely know that the price is now reversing, unless otherwise. So as you can see here, we want to identify the support and the resistance from this point here, right? So let's mark our chart. This is now we are still on 15 minutes time frame, and let's mark it here, and let's also mark it here. I'm using the horizontal ray. You can just find it from this point here. So this is the horizontal ray that you're using, okay? So you should know about it. And we see something here, right? So as you can see, for the support level, we see the price came down, and then we see some rejections, and then it went up, and then we see some rejection also here. It went down, it didn't close past this. So we are not seeing a full body close. We're only seeing some weak closes below the support, okay? And then we see there is no the price didn't pass through this point, and then we see the price reverses, and also didn't pass here, then price reverses, right? So for this particular, we see it is a support zone, and for resistance, we see it starts here, and then we see some rejections, and nothing passes this particular line. Rejection, and when it passed, and then there was a retest, and then the price went up, and there was another retest, and then the price went up. So this is like a breakout, okay? This was a breakout because remember we said that the price goes sideways, up or down. So this price was going down, and then there was a little bit of sideways here, and then when it broke, then it shows us that there is a potential of a reversal from the downtrend to an uptrend because of this small breakout here. So we see that there was a small breakout, and then price came up to retest, okay, to retest on that resistance level, and went up, and then came back to retest, and also went up forever. So we can see that these are now our key levels. So if you understand the key levels when trading the forex market, then you will be in a good position to understand what you're doing in the market. And another thing that we are also supposed to look for is the rejection candles, right? So if we see 3 or more candles, we see that there is a rejection. Sometimes 2, but 3 or more, there is always rejection. Like this one, there is a rejection. Here we see a rejection because the price, as you can see, this price was going down and it didn't pass this support level here, and then it went up. Then we see a rejection, and then we went down. We see some multiple candles here, rejection, and we see multiple rejection also here, multiple rejection here, multiple rejection here, and then it broke out. So when we are trading support and resistance level, we should look at the wicks. Okay, the wicks normally symbolizes the rejection and the engulfing candles, as you can see. So wherever there is some reversal, we see some engulfing here. So engulfing candle is a candle that the previous candle is either small and then the next candle is big, or the previous candle is big and the next candle is small. And this normally happens each and every single time. As you can see here, the reversal, this candle was going up, and then we see there was a reversal. Okay, this candle was going up, this is a small and this is a big one, this is a big one and this is a small one. Okay, this is a small one, this is a big one. So when we are going to up, then the previous one will be sometimes, or most of the time, it will be smaller. You see, like in this one, now this is another engulfing, this is another engulfing. When we're trading price action, those are the things we should look for. So first of all, we look for the rejection of candles, and another thing is the engulfing candles. So the wicks and the engulfing candles shows us some rejection. So let's look at this price action in front of us. And I've chosen this price action here because it is kind of a weird, because most of the new traders think that the price will create some good patterns, but sometimes when they find something like this, they now they don't know where to start from, and that's why I've come up to the price action chart. So let's start. We're going to start it this way. So let's follow up our path. So it started up, and this was a small move, and then it went up, and then it went down, and then it went up, and then down, up, and then you see we failed to break up this. Then we also failed to break up this. So this was a ranging market. Then we failed up to break up this. Okay, and then later on we broke it, right? And then we failed to break up this low here. Now this is now our strong low. We broke up this high, so that becomes our strong high. Then we failed to break up this low. Now this low still remains our strong low, to create another strong low, and then a weak high. Okay, and then a strong low which breaks up this high. Okay, and as we said earlier, if a low breaks up the previous high, that becomes a strong low, and when this high breaks up this low, then it becomes a strong high. So we still have a strong low. Okay, we still have a strong low, but now we get up a strong high. Okay, because this high here breaks up this low, okay, to make it strong, and then this low breaks up this high to make it a strong high. and so on and so forth. Okay, and so on and so forth. So that is our price action. So let's take here. I want us to look at something here. So we see that there was a key level here, right? There was a key level here. So we should know that when the price is going up or down, the price will not go up forever, or will not go down forever, or in a straight line, or it will not remain in a straight line. So there should be some retest at some point. Okay, and that's what we are looking at here now. So we want to see how we can use the retest to actually make our trades. So let me just delete this and we see what is happening here. So as you can see, the price went up. So the price went up and then down and then retested this point. This now they were our support level. Okay, so it was this now our resistance level. So the price went up to this point and then went down. It didn't break up this. So as you can see from also this one, the price, let me delete that. The price did not break from this support level. You see the price was failing to break up this support level and also this this resistance level and this support level. So we see the price went up, and when it broke out, okay, when there was a breakout of this point and then the price retested that particular point, that key level, and then went down. Okay, our anticipation was, so when the price goes up, there's a pullback, and then went down, then goes down as usual as this point. But we see that the point, this high does not take up this low. So we see we are remaining on kind of on a consolidation area here, and then there is another breakout here to clear out the liquidities up here, and then we see the price goes down. So we see that the price went up, then there was a pullback, and when it went down, it went back to that key level and then pushed down. Okay, so and then we went into consolidation. So if the price is in consolidation, we don't make any trades because we don't know the price will break up to the upside or downside, right? So the price broke a little bit to the upside here to clear all the liquidities here, which this was a fake move, and that fake move normally done by the banks and other big institutions for you to enter, for you to wait for a retest of this point and then put your stop loss, right? Okay, and then put your trade like this. So but the bank institution now, they induce you to now make a trade going up because there was a little bit of a breakout here, but now the price goes up. So thus we see that was just a fake out for you to be induced to go up, and then the price goes down, and then we see there's another break of this key level. Okay, and then we get a retest, and then retest, and then the price goes down. Okay, and another retest of that particular point, and the price goes down, but the price does not take out this low. So this one is also now another consolidation point. Okay, the price does not break out to the uptrend to up, or does not break up to down. So this remains a consolidation area. So after we see that the price broke out this, then there was another key level here, right? So the price broke out, and there was another. So the price went up and then down. As you can see, this was an up move and then a down move, up move, a down move, a up move, and a down move. So for this key level here, from the top, we see that there was a retest, as we see. So this is now an uptrend, but this was a downtrend. So for a downtrend, we put our support level to the lower lows, right? The lower lows, lower highs, and lower lows. But here we use the higher highs and higher lows. So it is something like this. Let me just draw something and you see what I mean. So if the market is trending up, right? If the market is trending up like this, then this is now our key level, right? So there is another break and we wait for a retest. There is a break and we wait for a retest. And as you can see, there is a break of structure, and then there is a retest, and then there is a break, and then there is a retest, and then a break. After every break of structure, there is a retest, right? So when the price breaks up, so your name will be a breakout trader because you're waiting for a breakout, right? You're waiting for a breakout, and then also wait for a retest. So you are looking for a breakout and wait for a retest, looking for a breakout and wait for a retest, a breakout and a retest, a breakout and a retest. So you enter your trades through this particular points here. Let me just delete that and I show you exactly what that is in the charts, right? So as you can see here, you're waiting for a breakout and then a retest, okay? But this was a consolidation, okay? So there was a breakout. So let's say here, a breakout of this key level and then wait for a retest. So it was something like this, what we have now discussed. So it was going down and then a breakout, okay? So we're waiting for a retest, okay? So there is a first retest and the second retest here, and then another breakout, okay, and then a retest. And as you can see, so this was our key level and this is another key level. You see, there was another retest here, so the price went up and you can see the price went up and there was some kind of a retest. Let me just take this here. Let me just take this one here, a retest, and then the price went up, right? So the price went up. So in all our trades now we are looking for a breakout and retest, and you see now the price did not break out this particular point, then another breakout here. So we see there is another consolidation here, there's another consolidation here, and another consolidation here, right? So as breakout traders, we are waiting for this particular breakout. So a breakout and a retest, so we can enter through this point, and I'll show you how you can enter that, okay, after looking at the liquidities. And you just take 1:2, 1:3, 1:4. So that will be a successful trade, and then a breakout from this key level, and then wait for a retest, and then another one, right? Okay, and then you wait for a breakout, right? A breakout like this, then you wait for a retest. So but you see, so we were waiting for a retest if the price would have gone up, right? Up and down for retest and then up, right? So but because here we don't see a breakout and then a retest, then will now definitely know that we are now on a consolidation zone. And then after this breakout, there's kind of a retest, and then the price also went up. So as you can see, that thing happens on the charts every single time. Every single day you'll find a breakout retest. So I'll show you how you can enter the break and a retest. So you wait for a breakout, and then you enter through a retest, and then you continue, and then you rinse and repeat. So when there is a consolidation like this, you don't trade, because we are now waiting for a breakout and then find a particular point, because as you can see from this, we have a consolidation, another consolidation here, and another consolidation here, another consolidation here. So if we don't find a breakout like this, we don't trade. Okay, we wait for another breakout and the retest. So this here would be like, we have a breakout and a retest, and you can see a retest and another breakout. But because we're not this low does not take up this high, then we don't trade, because this now will be now a consolidation. And you can see the consolidation went on to this particular zone also, right? So let me just delete this, and you see that there was this point and there was this point. So we were waiting for it to break out of this and then look for another trade. So we waited for this because this was now our support zone. The price was failing to break out of this zone here, and the price was also failing to break down downside, right? So we are waiting for a bigger breakout like this, like 2 to 3 candles, and then a breakout and a retest, a breakout and a retest, a breakout and a retest, something that we have discovered here. So that is how we trade breakout retest. Now for a downtrend, we see that there is a support level here, and then another key level, a key level, a key level, a key level, a key level, and so on and so forth. So after every break of that key level, we wait for a retest. So there is a break of this key level, and we see the retest comes back to this particular key level, and then another break, which is a break here of this key level, and then a retest, a break, and then a retest of this key level, a break, and then a retest, then a break and a retest. So when the price breaks down here, we see that there is another retest over here, right? Just come back to this particular key level, and then continue with the break of this key level, this line, trend line. Okay, so this is a break of this trend line, and then it retests this key level. So each and every single time that thing happens, and I can't say that it happens daily, but at one time in a day you'll find that that thing happens. Okay, so there is a break and a retest of each and every single movement. And for this, we see that there was a kind of a minor break, and then a retest of this, and so on and so forth. But if the price is like this, then that means you don't have to trade every single day. You don't have to trade every single time. There's a time that you should not trade, like this. You see, there is another key level over here. So this was touched like 3 times, and that means this was some form of a key level. And let's take this. You see, this was this one was another a point. So you see, it went back, it came down to that key level, it went back and touched the key level, it went down, it went back, and after it reached this point, so it shows us a particular, like this another one here. So you see, the market here is also not ranging, so this is another one here. So we should know how to mark up these points so that we can know how we can trade, right? So this was a fake move, and you see this just is dangling between the lines, right? Unless we get a breakout like here from these first key levels. Let me just delete this, show you something. So we see this one was just continuing, then after a break, now we see the price is now going up. So we should know all to understand all, you should understand all these key levels so that you can mark them correctly, so that when it breaks out of that key level, then you can know how to trade. So when it breaks up this key level, then we can mark up our key levels, right? We can mark up key level like this. So there was a break of this key level and a retest, so you can take your trade from here, right? So if you take your trade, let's take for example you take a trade from here, then that means you target like 1 to 2, 1 to 3, right? If we target 1 to 3, this will be our point, right? And that would be our goal, right? You see, so each and every single time that thing happens, the same as this point here, when it breaks this, you wait for a retest or a pullback, then you can take your shots from here, right? You can take your shots from this key level here, okay? You see, trading is easy. Don't complicate things on trading. So when you know all these key levels and you can mark correctly your key levels, and what you can do, you can just go to a particular chart, from this replay, or you can go to trading view replay, and then look at all the key levels, right? Don't make a haste, just look at all the key levels so that you can make your trades, okay? You can study what happens, like this thing, it broke, there is a key level, there was a retest of that key level, it broke. You see, that thing happens every single time. It broke the key level, it tested the key level, then it broke again, okay, it broke again, and then it retested the key level. This is now a break, this is another one here. You see, it broke, and then it retested the key level. You see, that thing happens every single time. So if you can know how the breaks happen and a retest happen, then you can win most of your trades. So now there are patterns that we are going to look at, so that it can help us to trade the break and retest. There are some patterns that I'm going to show you that you can use to trade the break and retest, and the first one is the trend line. So as you can see, this is our trend line here, right? So a trend line, when the base touches the trend line at least twice, then that is a best trend line to follow. So as you can see, there was a break, okay, and a retest of that trend line, then there's another break and a retest of that trend line, another break and a retest, a break and a retest, a break and a retest. So this one is trend continuation, right? This type of trade is called trend continuation. It's either a trend continuation to upside or a trend continuation to downside. And you can see this one is now a trend continuation to downside. As you can see, it still when it still respects our trend line here, then this is a trend line pattern. So as you can see, this now is up and this is down. So after every break of that key level, then we get a retest and then a break and then a retest, okay? But this down move was short-lived here, right? And then we see another differences here that the price is now going up, same as this trend line here. A break, after every break there is a retest, a break and a retest, a break and a retest. So this is one of the patterns that I'm going to show you in this video. First of all is the trend line up trend line and a down trend line. This is an illustration of the trend line, and you see, so this trend line is respected. Okay, this trend line is respected here, and sometimes the trend line can be broken downside, right? That's why we say here that it does not mean that the trend line is broken because the trend line is still holding, right? So if it's broken like some weeks here, some few pips down here, then we don't assume that the trend line is broken. So we assume that the trend line is still holding until it is broken, that we have a full candle body and a break and a retest of that trend line or that key level here, right? So if it breaks like a little bit here, then we still term that as a still hold of a trend line. You have to keep your mind open because there's not always a perfect breakout. So any of the time you'll find that there is no perfect breakout, like we saw somewhere here. That was a slight break. As you can see here, there was another slight break. If we can just touch it here, there was a slight break of this trend line here. Okay, so that's why we say there is not always a perfect breakout, right? If we have at least 2 points that is respected in the trend line, then we can consider that as a break and retest. Okay, so if there is 2 or more lines here, but with this, for this trend line we see it's 1, 2, 3, 4, 5 and 6. Well, this one is 1, 2, 3. So if there is 2 or more, then we still say that the trend line is respected. But if it's not, if it's broken, like the way it's broken over here, then we say that the trend line has now been disrespected. Okay, but if it's still holding like this, then we say that the trend line is respected. So this method of trading, we are looking for a trend line and a retest. So it's a break and a retest of the trend line. It's another break and a retest. If we draw our line here, we wait for that retest before we take our trade, and then we'll wait for another breakout of this key level here, and then we wait for a retest from that particular moment. And then when the trend line is disrespected, then we end up our movement and then focus on either downtrend or any other thing. Okay, so the trend line is respected until it is disrespected. Have that in your mind. So what we have discussed so far is the trend line here. Okay, so this is now the representation of what we saw down here. So this kind of a representation, and if you're drawing the key levels, you should know that you're drawing in the key levels from the top with respect to the bottom. Okay, from the top with respect to the bottom, while the other one is from the bottom with respect to the top. If it's a downtrend like this, so this was an uptrend and this was a downtrend. So these are the two major trends that we've seen so far, and these are the two major patterns that we've seen so far. And this is now the reversal of this one here, right? So this one is an uptrend, this one was an uptrend, and this one is now a reversal. So if there is a reversal, there is a break of this trend line and then a retest of that key level, and then the price goes down, the same as the downtrend. So this one is a reversal from an uptrend to a downtrend, while this one is a reversal from a downtrend to an uptrend. So we see that if the price passes the higher low, so it comes back to retest that level and then the price goes up. So let me show you example in the chart. So as you can see here, we saw that there was an uptrend. After that uptrend, we saw that there was a reversal and then a retest of that key level, right? So this was a key level, a key level, a key level, a key level. Then after the price broke down, then it needed to retest that key level to for the price to continue down. So as you can see here, we were referencing the top to the bottom, right? The top to the bottom, the top to the bottom. Okay, because now it's a reversal. So that's why when we see a bottom to the top, so we see a reversal after this break here. So we need a retest, and then price continues down, and then a retest of that key level, the price continues down. It's not perfect, but it's a retest kind of, and then price continues down. So far we have seen now the uptrend and the downtrend, and the uptrend reversal and the downtrend reversal. So another pattern that we're going to look at is the double bottom and the double top. So this happens when the price is going down, right? So it's a downtrend, and then when the price wants to reverse, it takes out the trend line. Okay, it trades past the trend line and then comes back to retest, but does not take up this low, right? It remains as the same low as the previous low. So that means it's a double bottom. So if you see any sign like that, then that is a potential reversal, right? The same as the double top. The price was initially trending upwards, it was an uptrend, and then the price broke up the trend line but did not take up the high of the previous high. Then it creates a double top. Okay, so when it creates a double top like this, then that means it's a potential reversal. So when you see anything like this, don't assume that the price is still going down, because there is a break of a trend line. So what you wait here is the retest of this bottom here. If it passes this bottom, then it will remain as this was a fake out. But if it does not, then if it's just some wicks that shows some rejections as we saw earlier, then that means that there is the double bottom. Is you look for buys, and here you look for sells after double bottom. So when the trend line is broken and then the price retests up this top here, then you know that this is a potential reversal. Now you look for sells, not buys. So here you look for buys, not sells. Okay, so those are the potential reversals of the other two main patterns. So let me just show you exactly what is happening. So as you can see here, the price was trending down, and after this break of this trend line, the price came up to retest this bottom, right? The price came up to retest this bottom, and then the price went up. So here, after the price makes up a double bottom here, that shows a rejection. You look for buys. For double top, you see the price was trending up, and after break of this trend line, the price went down. So after a break of this trend line and showing us a double top here, then we look for sells. Remove this, and you see after the break of this trend line, now we look for our sells. Okay, but it was short-lived because the price was going up. But this is on a 4-hour time frame. But if you go on a 15 minutes time frame, then you can have some trades there. Another pattern is the missed double top and the missed double bottom. So with this one, the other pattern that we have is the missed double bottom and the missed double top. There is a bottom here, right? And instead of the price coming down and create a double bottom, you see that the price goes up without creating this bottom. So that means the price is on a higher pace. This reversal happens each and every single time, but when it happens, that shows that the price is going up on a higher pace, and you can look to get in the trade immediately, because the price is quickly going up or going down, or the price is quickly reversing. So you see, the price was going down, this was a downtrend, and then it happens that after the break of the trend line, okay, after maybe the break of the trend line, as we discussed earlier, after the break of this trend line, we find that the price does not come up to this bottom to make a double bottom. The price goes up, it makes like a halfway or 3/4 and then goes up. So that means this is a missed double bottom. That means the price is going up impulsively, right? And this is the missed double top, and the price was an uptrend, and then the price went down and maybe took up that trend. Okay, let's say this was our trend and the price broke up this trend, but it did not come up to this top to make a double top. So that's why we call it a missed double top. So looking at this on the charts, you can see the price was going down and then there was a bottom, right? But this did not create a double bottom. It created a missed double bottom, and we see that the price was going up, right? So it was a quick reversal. It did not give us some confirmation of a double bottom or something of the sort. It just came down and then went up and then did not reach the bottom to make a double bottom, and then went up. The same as here. You see, these are always impulsive moves, right? So the price was going down, okay, and this created a double top, right? But instead the price broke up and went down. So these are impulsive moves. That's why you see after that missed double bottom, you see long wicks here. That means that was actually impulsive. Okay, so an impulsive move after that. So whenever because this is on a 4-hour time frame, whenever you see this on a 4-hour time frame, so you can scale down to 15 minutes time frame and look for entries, because these are impulsive moves. That means the price has now reversed impulsively. So far, these are the patterns that we have seen so far in this video, in this price action video, and is a uptrend, this is a downtrend. So each and every pattern has its own upward and downward alternative, right? So this is like, this one is an uptrend, this one is alternative to this is alternative to that, this is double bottom, this is double top, this is an uptrend, this is a downtrend, this is a respect of a trend line to up, then this is a respect of trend line to downwards, then this is a break of a trend line which shows a reversal, this break of a trend line which also shows a reversal to a downward, from an upward movement to a downward movement. And these are ranging market, and this is the missed double top. Okay, so for the uptrend, we are looking for a break and retest. Okay, so we look for this kind of a break and a retest of this line, a break and retest of that line, the same as the downtrend, break and retest of that line, a break and a retest of that line. While double bottom, we are also looking at the same for a break and a retest. Okay, so the price was going down and then there was a double bottom, so we're waiting for this break here, a break of this previous high, and then we get a retest and then we enter our trade. Same as the double top, we wait for a break of this, okay, of this high here, a break and a retest, and then we go. So it's a break, or sometimes if you are another trader used a break, okay, this was a break, and because this trend line was respected, because it was not taken out, so that means there is a possibility of a reversal, then you put your trades here. So for those who are minimalist, I can say, is they can wait for a break, okay, a break of the previous high, okay, because this was a high low, so a break of that previous high, then wait for a retest, or a break, a retest, because there was another high right here, then you wait for a break and a retest. If the retest does not take up the low, then you take from there. So the same case as this one, you get a break of this high and a retest from the formed high, or a break, okay, so you wait for the price to come back to this position. If it does not take this high, then you find your trades over there, right? So there is another thing in the trend line and retest. We are looking for a respect of a trend line. So long as the trend line is respected down here, then you can put your trades. It's just the same as this one, but this one is now wait for a respect of a trend line and a retest. So this is a respect of a trend line. So this was a respect of a trend line, then a retest, respect of a trend line, because it did not go beyond the trend line. Then you wait for a retest, the same as this one here. For range or consolidation, we wait for a break and a retest in order to buy and sell. So for this particular pattern, you wait for a break of either a high, so there is an imaginary trend line here, right? Because this trend line is being respected through on up and down, okay? So if there is a break of that trend line, and then we wait for a retest of that trend line, and then we sell, and then we buy. Or there is an imaginary trend line below, then we wait for a break of that trend line, then a retest of that trend line, and then down below, right? And lastly, second last is the missed double top or double bottom. So this is the price is stepping up, okay? So we see that the price was going down, and now the price is stepping up. It's respecting this low here. It's not the same as the double top or double bottom, which the price comes up to this bottom here or this top here, but in this, the price is stepping up. Instead of reaching to this point here, the price is going up, right? And the same as this one, the price is going down. So there was the last high, the price is respecting that high. So maybe there was an order block here, and then the price is going down. So on the break of a trend line, so this was a trend line, and then we get a reversal. So after a break of that trend line, we come back to retest this trend line here, and then we take our buys. Or we break this trend line here, there was a break of that trend line, then we retest on that trend line, and then we get some sales. So these are the only patterns that you should look for when you're trading price action. You can trade this on any pair. You can trade this on stocks, you can trade this on indices, you can trade this on gold, commodities, you can trade this on pairs. So I'm trading this on an index, which is US 30. So for this, I'm using the Fibonacci tool. If you don't know Fibonacci, you get Fibonacci from here, and then let me just show you how you can get it. So so this is the Fibonacci. It's called the Fibonacci retracement. So I've just favorite it and here, and then you go to the settings. This is the settings that I want you to make. For 0, you place 0, then 0.67 and 1. We only need 3, right? And then you can play with the colors over here and the visibilities, right? You can play with the coordinates, colors, and visibilities, but the main settings that I want you to do is 0, 0.67, and 1. Okay, so then you get something like this. So for this particular replay, we are looking for, this is now a downtrend, right? And for a downtrend, what we are looking for? we are looking for break like this, a break of this trend line here, a break of this trend line, right? This is a break of trend line, and I mean a break and a retest of that trend line. So what you should know that we're only looking for 1:2 and risk to reward. 1:2 risk to reward is enough for us, right? So this is now Fibonacci tool. Okay, so we find a break of this trend line here, so we can just delete it and we put our sell because the price is going down, right? So we put our sell. So if this triggers us to down, then we get our 1:2. So we only look for 1:2, right? This is now 1:2. So let's just replay that. That is a loss, right? But you see, it was something related to what we were saying here. So this is a loss. This is a loss. So what you should also know, you see, it was something close to that, but this is a loss. So what you should know that in trading, we have losses and we have our wins. Okay? So we have losses and we have wins. So if this is a loss, so let's put our trades. So between the 10 trades, how many losses can we get? How many wins can we get, right? So the losses, if the losses is just the same as wins, then we are on a plus side, right? There is an advantage because our risk to reward is 1:2. If our risk to reward is 1:1, then we lose 10, we get 10, then that is a minus. 1:2, 1:2. So if you risk $1 and then you get $2 back. So you risk $1, you risk $1 and get $2 back. So this is $1 times 2, that is 1:2. Then times 5 because there are 10 trades and you put 10 trades, and then let's take for example you lose 5 and you win 5. So for $1 with the risk to is 1:2, then with 5 trades minus $1, then you risk 1 but you get 2 if you win, but you risk 1 and you lose 1 if you lose, right? So times 1 times 5, so we have $5 plus, right? So because this will be 10 minus 5, this is 5, right? So with the risk 1:5, I mean 1:2, then we'll be still on a positive unless you have many losses than wins, right? So even if we have like 6 losses here, then this will be 6 and this will be 4. That will be 8 minus 6. That will still be 1. I mean 2, like $2, $3 profit. So that is what we lost here. But you see, we lost here. And let's go to another trade. I'll show what is happening. So this is a break of structure. So we see that this was an up. Okay, it was up. Break of that structure, a retest, a break, a retest, a break. So even if we took it here, right? Okay, even if we took it here, right? We still have our profits, right? If we will still have our profit because it was a break and a retest, right? We still have a profit. But I just wanted to go to the bigger picture here. Okay, so let me just play. The price is now going up. The price is now going up. So we take this from the top to the bottom. The price has now reached our point, right? If we took this sell, if we took these cells here, and then we place our trade here, and then down, right? We guess 1:2. Okay, so we are on our trade. That was a profit, right? So the first one was a loss and this one is now a profit, because we, after break, we waiting for a retest, and then down. Let's find another trade. That is the second trade. Let's find another trade, right? So the price is going down, the price is going down, but here we see we can as well place another trade here, and we wait for a break and a retest of that trend line, right? So, but sometimes you find that the price will not come to that point. It will just go up like this and then a break. So we are waiting for this break here, okay? We are waiting for this break of this line down here. Sorry, this break of this down here. So after we get that break, oh, there is a break of that trend line. So what you're looking for, we are waiting for a retest of this here, right? So we place our Fibonacci on top, below. So we are waiting for the price. So this is now our break of structure, right? This is now a break of structure. Let me just label that. That's our break of structure. So we are waiting for the price. So we are waiting for the bottom. Now this is the bottom has now been created, right? The bottom has now been created. So we place our Fibonacci tool and to the bottom, right? And this is on a 15 minutes time frame. So the price did not reach our point here of 0.67. So if the price has not moved to this point, then we leave that, then we go to the next. We find the next, right? We find the next. So you only trade when the price reaches our Fibonacci level, right? So there was no trade here. The price has not retested back. If there is no trading opportunity, don't trade, right? It's just as simple as that. Don't force some trades. You see, now there was an up, then down, right? So we put our Fibonacci here. We put our Fibonacci here. We see this was up, down, and then there's a break of this low. And then we wait for the price to retrace back to this particular point. So we put our cells here. You get the idea now. We put our cells here. Okay. So what are we targeting? 1:2. At least 1:2. We're not looking for more than that. So 1:2. So when the price reaches up this level, if the price reaches up this level, it will take us in the trade. So let's go. We're now in. That was a loss, right? And as you can see, now the price has wicked above our high here because of the liquidity. So those are the things you should look for when you're back testing, so that you can take your data and then you follow up what was happening there. So this was the first loss, right? This one was the first loss, then a win, then a second loss is here, right? But the trade idea was just the same, right? So now what is happening here, we used this, right? We used this point here, but maybe the price was coming back to our top here. So let's just take a big one. Let's just take a big Fibonacci here, and let's wait for the price. The price has now reached our point, right, as you can see, but let's just ignore it first and still we get a reversal. Because the price is now reversing, now we can take our trade from there, right? So we lost this one, but we are now profiting on this one here, because now what we did, let me just zoom it out. What we did, we used this here because there was a break, then down, up, down, there was another break here. So there was another break of structure down below here, as you can see. So that's one is what we lost here, right? So there was a break of structure here, but the price, instead of using this, the price was coming back here. So these are the things that you look for. So if you're losing much when you're replaying on this, like the smallest one, then you avoid them. You just use the big ones, right? So let's take our trades here and down, right? Targeting 1:2, we are good. So the price has now taken up. So the price is, see, let me just play it. So this is now the third loss. This is the third loss. So we see the price took us, and then it went down like 1:1, and then the price reversed. So that is our third loss. So this is our third loss. So because the price is now like, the price is moving up, let's just watch it to see what is happening. It's like the price was moving up, right? The price was moving up. So because the price was moving up, let's just take our Fibonacci tools. Fibonacci here, because there was a break of structure, and then the price went up, and then down, and then up. There was another break of structure. So we take this low here, right? We take that low, and then we put our buys, right? Put our buys right here. The price has tapped in into our trade. So did the price wicked us? No. You see, the price went up as if it was a blast of that, but then came down, right? So where did the price go? So the price came back to, there was a break of structure, so the price came back to this level, right? So the price came back to this level, okay? But this was a loss, right? Now we took the big one. Now we took the big one like we did here. So let's put our trade here, which we put our long here, taking this low. Then we anticipate the price to go up, right? You see, it was nearly making the trade. but the price is respecting the high here. It's like the price is stepping down. Okay. Okay. You don't remove your trade, right? You just go with it. It's okay. The price is now, we are in, right? Okay. So let's go back. We lost one. We lost one here with the price to Victors. Then we won the first one. We lost the second one. We lost the third one. We lost the fourth one. We won the fifth one. Okay. So we won the fifth one. So we find another one here. So the price has now broken our structure for Fibonacci tools down here. So we wait for the price to reverse. The price is reversing. Now this is the last high. The price is now reversing. Is it? We just play it. No, the price is not reversing. So we are waiting for another break of structure, and then we wait for a price to reverse. Is this the final high? Yes. No, it is not. It is not. But when you look at this particular, and mind you, this was we were on January, right? In January, the markets are not always good. That's why maybe we lost some few there. But in January, we are on profit, right? Are we on profit? Because we lost one, we won one, we lost two, we lost three, we lost four, we won two. So for two, taking our calculator over here, so we won, let's take, we were risking $100, right? And $100 we lost 1, 2, 3, 4, right? So we lost 4. For $100 we lost 4, and then multiply by 4 is 400. We lost 400 here, and then we won 2, right? So you see, so we risk 100. So this one now here, because it is a win, now it is 200, right? Because we risk 100 but we win 200. So we risk 100 and we lost 100, right? So this one we risk 100 but we profit 200, right? So times 2, right? You see, for the January we are on break even, because for the only two wins we are on a break even, because we lost 4 and we won 2. So if we could have won 3, then that would be plus 200, will be plus 200. So we lost 400 but we win 200. So this minus 400, the one that we lost, we're on 2. We could have been on 200, right? So we have not lost anything for the month of January. So we on a February here. We're on a February here, right? We're on a February. Don't fear losing in trading, right? Don't fear losing anything. So, and everything, when you lose, then you go back to check why you lost that trade. Okay, like what happened here, right? So we know that what happened here is that maybe we could have put our stop loss here, right? Stop loss on top of this, just the same thing that happens here. So we could have maybe used a bigger stop loss because there was a fair value gap over here. Maybe the price went up to that fair value gap before we're going down, right? So we are looking for some trade here, right? But because we have no trade, but we see there was an uptrend, down, up, a retest, up, right? So let's see if we could have placed our trade. This was an up, down, up. Let's say if we could have put our trade here, we could be in a trade, right? We could be in a trade there. But let's put this one here because there's a break and looks like the price is now retesting. Let's just put our Fibonacci over there. So let's go. If the price retraces back to this point, then we take our trade. Oh, the price has now retraced back, so we take some longs here. So as we said earlier, the price generally is going up, so we don't take any shorts here. We don't look for sells, we only look for longs, right? So let's go. The first loss for the month of February. Let's see if we can benefit or we can profit for this month of February. We are on 4th here. Looks like the price is now going down. No, is it? No. The price is now wicked down here. There was a break of structure and then break of structure. You see, the price has now retraced back. Oh, this could be a win, right? Because there was a break of structure. So now this is now the trend line. Let me show you. We were looking at this one here, right? We are now looking for this. Actually this. So because there was a trend line, there was this trend line. Okay, the trend line has been respected like twice, and then there was a break of this trend line. Okay, there was a break of this trend line. Okay, and then the price went back to that trend line and retested back. It's a typical example of this here. We lost here because we thought that the price was going up, right? But there was also a change of character. So because we didn't see that there could be a change of character after a break of this trend line here, that's why the price has now broken the trend line and went back and then is going down. Okay, so let's wait for a retest. So this could be a win, right? But we don't place our trade over there. But let's now go to this one here. Whoa, now let's take this and takes our shot from here, right? We take our shots from here to see what will happen. So you see, the price went down and we took up this trade. You see, as simple as that. So this is a win for the first win, a first win and a first lose for the month of February. We are using the FX replay here. So we're looking for another opportunity. You see, a trace back. So this was up, down, a retest. Now there's going to be another retest here, so we can take another trade over here, right? So the price, so we're waiting for the price to go up to this level and then take some shots over there, right? And then take them some shots. So the price, we are now in, but that was a loss, right? But that was a loss. So the price went back to this order block here. So let's assume that this was a loss, okay? We don't have to win everything, right? So let's take, this was a loss, right? You accept the losses. So the price went up. So it looks like the price went up to this level again. So the price, after the first win, the price went back to that level again and then retraced back. Wow. So it looks like the price is now going up. So we're waiting for a break of this line, right? We are waiting for a break of this line or a break of this line. So the price is now in this state, right? We are now ranging, right? We are now in this state. We are ranging or a consolidation between these 2 points. When it breaks down, we look for sells, and when it breaks up, we look for buys, right? So you wait the price to break, right? The price is still ranging. It has not broken. The price has not broken anything here. So let's go. Let's just speed this thing up. We're just speeding this thing up. Oh, the price is now broken, right? So what are we waiting for? We are waiting for a retest of this line here. So before we look for buys, guys, you see how this trading is easy. So this the liquidity points, so this is our low, then a high. So we are waiting for the price to break up to this point. It has not, right? It has not. It has actually retested, right? As you can see, the price has now, oh sorry, the price has retested this trend line here, and then we see a continuation. Is the typical example of what we've discussed, guys. See what is happening? So we place it there, so we wait the price to go up, and then when it retests back, so when the price is retesting back, now the price is retesting back, the price is retesting back, the price is not breaking any points here. Whoa, the price has reached our point. So we take some, what do? You don't have to take I mean, you can wait for reversal, but I'm just showing you. You can go to a lower time frames, like in 5 minutes. You can go to 5 minutes maybe. You can check what is happening and then put your sells, I mean put your buys. So but you can see the price has reached our point, and the price that's what I'm telling you. You can go to 5 minutes time frame, but when we're looking for 5 minutes, 15 minutes time frame, that means we are putting our market we're placing order on the market. So but if we go to a lower time frame, then you can see things happening on a lower time frame.
It's 21 hours.
So that was a loss. See, that was a loss, right? We have to accept the losses. So the price went back to like, so that means the prices tested our previous Fibonacci, right? Like the price is testing for previous Fibonacci, right? So we are waiting for reversal here. See what is happening. Okay. No, the price is going down. Okay. So for the month of February, we won like, yeah, we lost one. We won one, we lost one. We lost second one. Now this is the third loss, right? So let's take, oh, the price is now going up, right? Whoa. Okay. So because we're on a 15 minutes time frame, we see the first break of structure, break of this trend line, and then this is now where for this, what is happening here, let's say we are here, right? We are here. The price was going down and a break of this trend. So the price was going down. Okay. And then there was a break of a trend line. A break of a trend line. Let's mark that up. So we were waiting for a retest of that trend line, right? So as usual, our Fibonacci tool, and then we place our sells, our buys, because the price has now broken our trend line, right? At least 1:2, right? 1:2. We don't want to be greedy in the market, but looks like the price has not retested that. Oh, the price is now coming back. Oh, so it was a bigger picture. It was a bigger picture like that, and we are testing this. So we are coming back to this point. The price has now wicked us, right? The price, we are on our trade. Oh, so that's our third loss, and we are waiting for another. So it did not come back to this point, so we were using now this. Now we are on our trade. So let me just show you, we are on a trade here. We are now on a trade. So we're looking for 1:2 at least. That was a win. And we're also looking for, after this break of structure, so how many did we win and how many did we lose on the month of February? That's what we're looking for here. Since I do not want to bore you to death with this backtesting video, I'll just stop it there. So the month of February is half like 18, I just don't want this video to go for 5 hours, for 3 hours, because I'm backtesting on the screen. You can just do that by yourself, because most of you maybe are not trading US30, maybe you're trading some pairs, right? So you backtest your pair, you just buy the FX replay, or you go to the trading view. So everything, you can find them in the description below, so you can have them and test them. So this is 18th of February. So we won 1, 2, 2 and 3, right? So we won 3 and we lost 1. There was another loss here, 2, 3, 4. We lost 4 and won 3. So we lost 4. Let's go to our calculator here. So we lost 4. So we won 3. So 3 is 200 multiplied by 3, right? We won 3 and we won 3 and we lost 4. So 2, because the risk reward is 1:2, 100 multiplied by 3, right? But we lost 4. Then 1, because we win 2, we lose 1 for the risk to reward, right? Multiply by 100, because each and every trade we are placing at 100, for example, and multiply by 4. Okay, so we are still profit of 200. So that's how you trade. You don't fear the losses, but you capitalize on the losses. But as you can see, we were using 1:2 risk to reward, right? So if you could use like 1:3, 1:4, we could be benefiting more, right? But we don't want to go to that extent. We only take 1:2 and we are out, right? And 1:2 is not exactly 1:2. Like this one was 1:2.1. This was exactly 2. And this one was exactly 2.01, right? So we have won more than we lost. So if we tally, we lost 4, but we won 3, but our overall win was positive. It was not on a negative. So that means if you can go on and on with this formation to Friday, so this was Thursday, this one was Thursday, right? Then Friday 18th to 30th, maybe, or 28th of February, right? Then you can see what will happen when you do that, right? So you can go to the FX replay or any other replay software and see what is happening, right? So if you're new to this video, or if you're new to this channel, smash the like button and turn off the notification bell, because from now 2025 to onwards, then I'll be teaching you real trade examples, like step-by-step videos. So these are the paid videos, okay? If you go to other channels, these are paid videos, but I will be posting them here for free. So make sure you subscribe and turn on the notification bell, because this will be your go-to channel for trading. See you in the next video.